All right, let's dive right in. Deep within the engine room of the Indian stock market, there's this quiet but massive battle going on. It's between two absolute giants. And here's the thing. They are the backbone of literally every single trade you make, but they play by totally different rules. So let's get into it, the story of NSDL versus CDSL.
So, let's set the stage, shall we? In one corner, you've got CDSL. We're calling them the king of crowds for a reason. They represent the massive, surging wave of individual investors. Then, in the other corner, we have NSDL, the titan of treasure. These are the folks holding the keys to the vault, the immense wealth of the big institutional players. This is a classic showdown, and we're going to break down exactly who has the edge here.
So, to really get a handle on their core strengths, you gotta understand this one powerful dynamic. It really boils down to this. It's the people versus the power. The sheer number of everyday investors against pure concentrated money. Let's see what that actually looks like when we put some numbers to it. Okay, so let's start with CDSL, their strength. Well, it's all in this one absolutely huge number. Over 16 crore, that's more than 160 million individual DIMIT accounts. I mean, that's just a staggering figure, right? It's the perfect picture of the retail investing boom we've seen in India. This is their kingdom, their home turf.
And when you look at it visually, it's not even a close fight, not by a long shot. CDSL's dominance here is just overwhelming. They have the masses, the crowd, squarely on their side, and believe me, that is a massive, massive strategic advantage.
So what does that actually mean? Well, it translates to an incredible 80% share of the retail DMAT account market. Just let that sink in for a second. 80%. Chances are, if you or any of your friends started investing in the last few years, there's an 8 out of 10 chance your account is with CDSL. It is a near monopoly on the everyday investor. Just wild.
Okay, 80% market share. That sounds like a knockout blow, doesn't it? Game over, CDSL wins. But hold on. Having the most fans in the stadium doesn't always mean you have the strongest team on the field. See, the number of accounts, that only tells you half the story. The real question is, where is the money?
And bam. This is where the entire narrative just gets turned completely upside down. When we look at something called assets under custody, which is just the total value of all the stocks and securities being held, the picture is the complete opposite. NSDL, our titan of treasure, is the undisputed heavyweight champion here. They're holding vastly more wealth than CDSL.
And that right there is the fundamental difference. It's the core of this whole thing. CDSL has, 160 million accounts from people like you and me. But NSDL, they hold the accounts of the real giants. We're talking mutual funds, insurance companies, huge foreign institutions. It's a much smaller number of clients, yeah, but they're controlling trillions in assets.
So the big question is, why? Why does this massive split even exist? Well, I can tell you it's not by accident. It's because each of these players has some really unique strategic weapons in their arsenal. So let's unpack them.
Okay, for CDSL, its big weapon is that huge retail network. It acts like a powerful defensive moat around its business. Most of the popular discount brokers, the ones that brought millions of new investors like us into the market, they're plugged into CDSL. Why? Because it's just easier and cheaper for them. And what this does is it creates this amazing funnel pouring new retail investors right into their ecosystem. It's a self-perpetuating cycle of growth.
Now, NSDL has a very different kind of weapon, a real ace up its sleeve, and that's its tight grip on what we call foreign institutional investors, or FIIs. These are the giant overseas funds that pour billions and billions of dollars into the Indian market. And for whatever reason, they overwhelmingly choose NSDL. So why is that?
Well, it all comes down to something called the ISIN logic. It sounds kind of technical, but the idea is simple. Think of it this way. Every single stock has a unique digital fingerprint, and that's its ISIN code. Now, because NSDL was the first depository in India, they were the ones who issued the original fingerprints for many of the biggest, most important companies. That first-mover advantage is huge. It basically made NSDL the default gateway for big international money, and that legacy advantage is still paying off for them today.
And that's not all. NSDL has another card to play, the NSDL Payments Bank. Now, this could be a real game changer. What it lets them do is build a complete financial ecosystem. They can seamlessly link up a bank account, payments, and all those huge institutional investments all under one roof. That is a seriously powerful strategic asset, and it's one that CDSL just doesn't have.
Okay, so all of this background, this whole battle, it brings us to the final and maybe the most high-stakes chapter of our story. NSDL is getting ready to launch its IPO, its initial public offering. And they've put a remarkably ambitious price tag on themselves, which has sparked a huge debate across the entire market.
Now, to get what this debate is all about, you really only need to know one term, the PE ratio, price to earnings. In super simple terms, it's just a number that tells you how expensive a company's stock is compared to the profit it actually makes. So a really high PE means investors are willing to pay a big premium because they're betting on huge growth down the road.
So what's the magic number for NSDL's IPO? What's their proposed PE ratio? A towering 75. Yeah, just to give you some context, that is way higher than a lot of other well-known high-growth companies. It's a seriously aggressive valuation, and it has definitely raised a lot of eyebrows. And that, right there, leads us to the central question that everybody is asking. Is a PE of 75 actually justified? I mean, does NSDL's dominance with the big institutions and the future potential of its payments bank make it worth that price? Or is this valuation just a burden that's too heavy to carry? Is it setting expectations so high that they're almost impossible to live up to?
So, as this titan of treasure gets ready to step into the public ring, this really is the ultimate question for any investor, right? Is betting on this valuation a winning move, a bet on institutional power? Or is it a heavyweight burden that maybe, just maybe, overlooks the unstoppable force of that retail crowd? Well, at the end of the day, that's something the market itself is going to have to decide.